Gold price movements and market trends affecting investors today.
Hello everyone. Welcome back to the channel. Today's video is extremely important for anyone who invests, especially if you care about protecting your money, growing your wealth, and understanding where the global economy is heading. Today we are talking about gold price movements, market trends,
and how these changes are affecting investors right now.
Gold is not just a shiny metal. It is not just jewelry. Gold is money. Gold is protection. Gold is history.
And gold is a powerful signal of fear, confidence, inflation, and global uncertainty.
In this video, we will break everything down step by step, in very simple language. No complicated finance words. No confusing charts. Just clear explanations. By the end of this video, you will understand why gold prices move, what is pushing gold up or down today, how inflation, interest rates, and central banks affect gold, what smart investors are doing right now, and what you should watch in the coming months. So sit back, relax, and let's begin.
Why gold matters to investors. Gold has been valuable for thousands of years.
Long before stock markets. Long before banks. Long before paper money. Gold does not depend on any government. It does not depend on any company. It cannot be printed. It cannot be created out of thin air. That is why investors turn to gold during uncertain times.
When markets crash, gold often rises.
When inflation destroys buying power, gold protects value. When currencies weaken, gold becomes stronger. This is why gold is called a safe haven asset. A safe haven means something investors trust when fear increases. Gold is also known as a hedge. A hedge against inflation. A hedge against currency collapse. And a hedge against economic instability. But gold prices do not move randomly.
They move for specific reasons.
And today, those reasons are stronger than ever. How gold prices are determined. Gold prices are influenced by several key factors. Let's break them down one by one. First is supply and demand. Gold supply comes from mining. Mining is expensive. Mining takes time.
And mining output grows very slowly.
Demand comes from jewelry buyers, investors, central banks, and industrial uses. When demand is higher than supply, prices rise. When demand falls, prices fall. Second is inflation. Inflation means prices of goods go up, and money buys less. When inflation rises, investors look for protection. Gold is one of the top choices.
So higher inflation often leads to higher gold prices.
Third is interest rates. This is extremely important. Gold does not pay interest. Gold does not pay dividends.
So when interest rates are high, investors prefer bonds and savings.
When interest rates are low, gold becomes more attractive. Lower interest rates usually help gold prices rise. Fourth is the US dollar. Gold is priced in US dollars. When the dollar is strong, gold becomes more expensive for other countries.
This can push gold prices down. When the dollar is weak, gold becomes cheaper globally. This can push gold prices up. So gold and the US dollar often move in opposite directions.
Fifth is global uncertainty. Wars, economic crises, banking problems, political instability. All of these increase fear.
And fear drives investors toward gold.
Recent gold price movements. Now let's talk about what has been happening recently.
Over the past months, gold prices have shown strong movement. At times hitting record highs.
At other times pulling back slightly.
This tells us something very important.
Investors are uncertain. Markets are nervous. And confidence in the global economy is fragile.
Several major events have contributed to this.
High inflation in many countries. Rising government debt. Geopolitical tensions. And uncertainty around central bank policies. Gold has been reacting to each of these factors.
Whenever inflation data comes in higher than expected, gold rises. Whenever interest rate cuts are expected, gold rises. Whenever global tensions increase, gold rises. But when interest rate hikes are announced, gold sometimes falls. When stock markets rally strongly, gold may pause or pull back.
This push and pull is normal.
But the overall trend tells a story. And that story is that investors are seeking safety.
Inflation and gold. Inflation is one of the biggest drivers of gold today.
When inflation is high, cash loses value. Savings accounts lose purchasing power.
People feel poorer even if they earn more. Gold has historically held its value during inflationary periods. This is why investors often increase gold exposure when inflation remains stubbornly high. Even when inflation starts to slow, investors remain cautious. Because inflation can return. And central banks may lose control. This fear supports gold prices. Another important point is real interest rates. Real interest rates equal interest rates minus inflation. When real interest rates are low or negative, gold performs well.
Right now, many investors believe real rates will stay low.
This belief is a strong support for gold. Central banks and gold. Central banks play a huge role in gold markets. Central banks control interest rates. They control money supply.
And they manage national reserves. In recent years, central banks around the world have been buying gold
at record levels. Why are they doing this?
First, to diversify away from the US dollar.
Second, to protect against sanctions and financial risks.
Third, to strengthen confidence in their currencies.
When central banks buy gold, they reduce supply in the market. This pushes prices higher. This trend is extremely important. Because central banks think long-term.
They do not trade gold for short-term profit. Their buying signals deep concerns about the global financial system.
Interest rates and Fed policy.
The Federal Reserve is one of the most powerful forces affecting gold. When the Fed raises interest rates, gold often faces pressure.
When the Fed pauses or cuts rates, gold usually benefits.
Today, investors are closely watching every word from the Fed. Even small hints about future rate cuts can move gold prices sharply.
Markets are forward-looking. They react to expectations, not just actions.
If investors believe rates will fall in the future, gold starts rising now.
This is exactly what we are seeing.
Uncertainty around future monetary policy is keeping gold supported.
Geopolitical risks in gold. Gold thrives during chaos. Geopolitical risks are increasing worldwide. Conflicts, trade tensions, sanctions, political instability. Each of these events adds uncertainty. Investors do not like uncertainty. They like safety. Gold provides that safety. When headlines turn negative, gold often reacts immediately. This makes it a powerful hedge against unexpected shocks. Stock market volatility and gold. When stock markets are strong and stable, gold may lag.
But when volatility increases, gold shines.
Many investors use gold as portfolio insurance. Even a small allocation to gold can reduce overall risk. This is why financial advisors often recommend gold exposure. Not to get rich fast, but to stay protected. In times when stock valuations are high and risks increase, gold becomes more attractive. Gold versus cryptocurrency. Many people compare gold to cryptocurrencies. Both are seen as alternatives to traditional money. But there are key differences. Gold has thousands of years of history. Crypto is still new. Gold is physical. Crypto is digital. During extreme market stress, gold has proven reliability. Crypto has shown extreme volatility. Some investors hold both. But during fear-driven periods, gold often attracts more capital. What investors are doing today? So what are investors doing right now? Many are increasing gold exposure. Some are buying physical gold. Others are buying gold ETFs.
Some are investing in gold mining stocks.
At the same time, investors are staying flexible. They are watching data. Watching central banks. Watching inflation numbers. Gold is being used as protection, not speculation. This tells us something important. The mood in the market is cautious. Common mistakes investors make with gold. Let's talk about mistakes. First mistake. Trying to time gold perfectly. Gold is not a day trading asset for most investors. It is a long-term hedge. Second mistake. Going all in on gold. Gold is protection, not a replacement for diversification. Third mistake. Ignoring macroeconomic signals. Gold reacts to inflation, rates, and currency trends.
Ignoring these leads to poor decisions.
What to watch next? Here are key things investors should watch. Inflation reports. Central bank meetings. Interest rate expectations. Geopolitical developments. US dollar strength. Each of these will influence gold prices. Staying informed is critical. Long-term outlook for gold. The long-term outlook for gold remains strong. Debt levels are rising. Currencies are being devalued. Geopolitical tensions are increasing. And trust in financial systems is being tested. These are all supportive factors for gold. While prices may fluctuate short term, the long term case remains intact. Final thoughts. Gold is not about hype. It is about protection, stability, and confidence. In uncertain times, gold reminds investors of value beyond paper money. Understanding gold price movements helps you understand the world. And today, the world is uncertain. That is why gold continues to matter. Thank you for watching. If you found this video helpful, like, share, and subscribe. And let me know in the comments what you think about gold. See you in the next video.